All right, welcome to Talk Tickers. Today, we're diving into the DraftKings Q4 2025 earnings call. And this one was a real head-scratcher. The top-line numbers looked fantastic, but the market's reaction? Absolutely brutal. So we're going to unpack what really happened, look at the strategy, and figure out what it all means for the stock. So here's how we're going to break it all down. First, we'll hit those headline numbers that caused all the confusion. Then we'll get into the real story, the guidance disconnect. After that, we'll look at their big, risky bet on prediction markets, put it all into context, and then we'll give you our final take, the Talk Tickers rating for the next quarter. Okay, first up, the headline numbers. And this is where you see this immediate, jarring conflict between the past and the future, between what the company reported and what investors heard. It's a classic case of mismatched signals. I mean, check this out. On the surface, you've got this incredible top-line growth. Revenue up a whopping 43% year over year to almost $2 billion. In today's economy, that is an absolutely stellar number that should have had investors cheering. But here's the first little crack in the story. The bottom line. They missed. Adjusted EPS came in at 36 cents, but the street was looking for 39. Now, you might think 3 cents, what's the big deal? Well, it was the first sign that all that amazing growth wasn't quite making its way down to actual profit as smoothly as everyone hoped. And then, bam. This is the market's final verdict. The stock just cratered, down 13.5% on the day. And look at the volume, almost 4 times the average. This wasn't just a little profit-taking. This was a massive, widespread rejection of the story, telling you that Wall Street looked right past that shiny revenue number and saw something it really didn't like. So that brings us to the main event, the real damage. The thing that caused that massive sell-off wasn't the quarter they just reported. Oh no, it was all about what they said is coming next. Their forecast for 2026 is where the story completely fell apart for investors. And just look at the size of this miss. It's huge. The street was expecting revenue around $7.3 billion. Management came out and guided for $6.5 to $6.9 billion, not even in the same ballpark. And it was even worse for their earnings forecast. Analysts were looking for almost $1 billion, and the company guided way below that. This wasn't a small adjustment. This was a complete top-to-bottom reset of expectations. You gotta give CEO Jason Robins some credit for being incredibly honest on the call. He basically said, look, my team brought me a forecast, and I told them to go back and lower it because we just can't afford to miss expectations again. It's a classic move to regain credibility, underpromise and overdeliver. But what it screams to the market is that the path forward is a whole lot tougher than anyone realized. So you have to be asking, why? Why the sudden caution? Why the big cut to the forecast? Well, a huge piece of the puzzle is a massive new strategic bet they're making, a very expensive push into the wild world of prediction markets. Now, for anyone who's not familiar, what are prediction markets? Just think of them as the stock market for anything and everything. Instead of buying a share of a company, you're buying a contract on whether something will happen or not. You can trade on who wins an election, what the weather will be, you name it. And this slide gets to the very heart of the conflict. Management is telling this incredible story about a brand new $10 billion opportunity, a way to leverage all their tech and all their customers. But the market? The market is looking at the price tag for this new venture and sees something completely different. A ton of cash being burned, lower margins, and a profitability story that just got pushed further out into the future. Oh, and here's the absolute kicker. You ready for this? That super low guidance for 2026 we just talked about, it includes all of the spending, all of the investment to build out this new prediction market business, but it assumes they will make exactly $0 in revenue from it. Zero. Zilch. So all the costs are baked in, but any potential reward is, for now, a complete question mark. Okay, so let's zoom out for a minute, because you can't analyze a stock in a vacuum. You have to understand the neighborhood it lives in. And right now, the investor sentiment for this entire sector has gone through a massive shift. And yikes, I mean, this chart says it all, doesn't it? Over the last year, the broad market, the S&P 500, is up over 13%. DraftKings, on the other hand, has been taken to the woodshed, down almost 60%. It's proof positive. The days of just rewarding companies for growth at any cost are long gone. So what's the lesson here? It's that the rules of the game have totally changed. Investors today want one thing, a clear path to profitability. They are rewarding companies that can grow their margins, And they are absolutely punishing companies like DraftKings that are lowering their guidance to go spend a ton of money on speculative new projects. The whole conversation has shifted from how fast are you growing to what's my return on that growth. Which brings us to the bottom line. We've laid out all the evidence, the good, the bad, and the very expensive. So based on everything we've heard, here is the official Talk Tickers rating and our thesis on DraftKings. Our rating on the stock is underperform. Look, the long-term vision they're selling is ambitious, and it could be huge. But the short-term headwinds, the cash burn, the uncertainty, it's just too much to ignore right now. Let me explain exactly why. So here's our thesis, plain and simple. Long-term, this prediction market play could be a home run. But for the next year or so, that 2026 cash burn is going to act like an anchor on the stock price. We think the stock is basically going to be stuck in the mud, trading sideways as the bulls who love the dream fight it out with the bears who hate the spending. So if you were looking for a trade idea, you could consider long-dated puts or maybe a pair trade. Go long on a competitor that's focused on profits today and short DraftKings to play this period of heavy spending and uncertainty. And that's our take on the wild quarter from DraftKings. Of course, we have to remind you this content is for informational purposes only and is definitely not financial advice.